control
Yes,
it.
I'm here
When
only.
they are talking in the podium, they should be visible, right? So it should be rotated.
But then the thing, हाँ चल okay, don't worry, we'll do that.
Welcome back, everyone. I believe you have all been enjoying the session so far and you have had your refreshments. As we move forward in today's proceedings, it is my pleasure to introduce Mr. Nirmay Choksi from NJ Asset Management Private Limited, our knowledge partner and our keynote speaker. Mr. Nirmay Choksi is the Associate Director and Head of Investment at NJ Asset Management Private Limited, where he leads research, fund management, and dealing functions for asset managers through fully rule-based quantitative investment strategies. A graduate in accounting and finance from the University of Warwick and a CFA charter holder, he began his career as a research analyst and has played a pivotal role in building the NJ Smart Beta research platform. He oversees a team of 18 professionals and heads the Business Intelligence Unit, driving business development, MIS, and target setting for the AMC's sales function. Prior to NJ, he worked as a financial data analyst at ETFGI in the UK. A passionate table tennis player, he has presented his school in university at state and national levels. I would like to request Mr. Nirmay on stage and invite Senior Coordinator Brahmaji to felicitate with a bouquet of flowers. Welcome to Vriddhi 7.0, sir. It is an honor to invite you to deliver a keynote session.
Very good morning, everyone. So, before I begin, I just want to know how many of you all are interested in finance. You can raise your hands. Oh, quite a lot. Maybe not a few people over there. Okay. Now, how many of you all currently invest as well in the Indian markets through mutual funds or maybe direct equities? Amazing, amazing, great. And how many of you all are aware about this term known as rule-based investing? Can I get the slider, please? Okay. Yeah, how many of you all are aware of this term known as rule-based investing? Anyone? No, okay, so great. So this, I hope, is gonna be a good learning for you all. So specifically those who are the finance enthusiasts who are, envisaging a career in investments in portfolio management specifically. So you must be aware that within the field of finance, there are two sides. One is the sell side and one is the buy side, right? Most of you all must be aware of the sell side and the buy side. Are you all aware of it? And on the buy side, what is the buy side? Basically, it is the asset management business. One of the main businesses within the buy side is the asset management business, which is also known as investment management, such as mutual funds or portfolio management services. And within asset management, there are different styles of investing, such as active investing, passive investing, and rule based investing. So this rule based investing that you can see on the screen is the new way of smart investing. It's a very prevalent way of investing which has emerged out as a very prevalent and strong force in the United States and in the Western markets. However, in India, it is quite new, it is quite nascent, but it is evolving at a rampant pace. So that is what we'll be discussing. And before we talk about rule-based investing, I'll talk a bit about our group as well, the background, the genesis of our asset management company, what has been the kind of growth, as I said, in the United States, what is the growth that we've been witnessing in rule-based investing in India in the past few years as well, and obviously what rule-based investing is, how it is different from active investing or passive investing, what is active passive investing as well, what are the benefits of rule-based investing. I'll talk a bit about our investment philosophy at NJ Asset Management, what we've been doing. We manage mutual funds as well as portfolio management services. We have a total assets under management of 11,500 crores, and we've been managing 7,000 crores in the mutual fund scheme. We have schemes such as the Flexi Cap Fund and the Balance Advantage Fund, which I will cover, and also we have some 4,500 crores assets under management on the portfolio management services PMS side. So how we've been managing those portfolios, what philosophy that we have, what methodology we follow, that I'll be talking a bit about that. And lastly, I'll talk a bit about our research platform and the NJ Factor Investing Olympiad. It is a great initiative specifically for the finance enthusiasts who really want to learn more about this field of rule based investing, also known as smart beta or factor investing. You all must have received that booklet as well. You can go through that. So I'll talk a bit about that. So to start with, if I talk about the NJ Group, the genesis of NJ Asset Management, before that I need to talk about NJ Group, because NJ Group is the largest mutual fund distributor in the entire country. It is the parent company NJ Wealth, which is the mutual fund distributor. That is the parent company of NJ Asset Management, and this company was started roughly 31 years ago in 1994, and today we are the largest asset manager, I think. Yeah, okay. We are the largest we are the largest wealth managers, mutual fund distributors in the entire country, managing, as you can see over here, more than 2,80,000 crores of assets under management or assets under advice through a network of more than 50,000 mutual fund distributors spanning across the country, and a network of more than 40 lakh investors. So we have more than 40 lakh investors, more than 4 million investors. We have a investor base of more than 5 lakh investors who stayed with us for a period of more than 10 years, and we have a distributor network of, as I said, more than 50,000. And this, we've established this over the past 31 years, as I said, and what we felt over the years was that now, because we met a lot of asset management companies, we saw how they are managing funds, what are the different styles of investing and all. We felt that there is a space in this asset management business as well, specifically in the Indian market, for rule based investing, and that is how we kind of started our journey in the asset management space. So back in 2009 we launched our mutual fund business back in 2021 only, so it's a recently new business, about 4 years old. However, our asset management journey is about more than 15 years old now. We started it back in 2009 with the launch of our portfolio management services, where we were doing asset allocation between equity mutual fund schemes and debt mutual fund schemes through a rule based strategy. Then over the years we did a lot of research in the field of rule based investing. We were trying to understand what were the kind of trends that were companies that are present over here in India. So just to give you a context, there are about 50 asset management companies today, or AMCs as we call it, that are present in the Indian market, managing a cumulative total assets under management of about 79 lakh crores, so under $1 trillion. And most of these asset management companies that are present today, they are managing money in what is known as traditional active withdrawal investing. So that's how we felt that, from a genuine diversification standpoint, there is a big opportunity for us to give something which is very unique, give something which is very different, and which has not been that adopted in the Indian markets as well. And just to add one more point, so in the distribution side as well, we kind of were the front runners, we were the pioneers of what is known as SIPs, systematic investment plans. I'm sure most of you all know what SIPs are, right? And most of you all must be investing through SIPs as well. But about 15-20 years ago, when nobody was ever talking about SIP, NJ Group, NJ Wealth was the only entity in the country that was aggressively promoting wealth creation through SIPs. And nobody believed us at that point of time. But today you can see that we have an SIP book of about 30,000 crores at an industry level, and NJ has a market share of about 8 to 9% in that SIP book at the industry level as well. So that same thing we were envisaging in the asset management space as well. So as I said, we looked at the data. So this is a very interesting statistic. What this shows is that the growth of equity rule-based strategies in the US over the past 24 years, from the year 2000 to year 2024, and there are different names for rule based. It is also known as smart beta, it is also known as quantitative investing or quant investing, it is also known as factor investing, and obviously rule based investing. But these are all the different synonyms for what the same kind of investment strategies, which I'll be explaining as well. So what this data shows is that over the past 24 years, there has been a humongous growth in the assets under management of these kind of equity rule-based strategies in the US market. So just to give you an illustration, 24 years ago, back in 2000, hardly a few billions of dollars were being managed in these kind of rule-based strategies in the US, right? And today, after 24 years, that has surpassed more than $2.2 trillion in the US market itself. Just the equity rule-based, ETS equity rule-based strategies, that is more than double the entire market size of the Indian mutual fund industry. It has compounded at a staggering growth rate of about 36% over a 24-year period. And if someone is aware of the rule of 72, and at a growth rate, compounded growth rate of 36%, your assets double every year, every second year, right? So that is the kind of growth that we witness in the rule-based world in the foreign market, specifically in the US, and that is what motivated us. And nobody is doing this over here, so there's a big opportunity. And what I was talking about, that in India, it is while at a very nascent phase. If I talk about today, if you look at the passive as well as active rule-based strategies in India, that is about 80,000 crores, less than 80,000 crores in assets under management. And I said that the total industry size is how much? About 80 lakh crores. So it is just 1% of the industry today we are in terms of rule-based investing. So it is very minuscule. But if you look at the growth that has happened over the last 5 to 6 years, you will see that that has the AUM, the kind of money that has been coming into these kind of strategies has more than increased by more than 100x over the past 5 to 6 years. So that also again clearly shows that a lot of asset management companies are now realizing that yes, active investing is definitely important, but at the same time there is this new smart way of investing known as smart beta investing or rule based investing, which cannot be ignored. And that is why a lot of players in the market, as you can see over here, the red bars indicate the number of products. You can clearly see that the red bars have increased significantly in a very exponential manner as well over these years, because more and more players are now understanding it, accepting it, and they are bringing these kind of strategies in their portfolios, in their offerings to the investors. So what exactly is rule-based investing? So before understanding rule-based investing, let us understand what passive investing and active investing is. So passive investing is, as the name suggests, a very simple form of investing where a fund management team, where a mutual fund team or an asset management team, they believe that if the Indian markets, say for example Sensex or Nifty, you all have heard of Sensex and Nifty, right? So, say for instance, they believe that Sensex or Nifty has delivered about 14.5% return over the last 20-25 year period. And they believe that the portfolio that the Nifty 50 has, it has a 50 stock portfolio. They believe that the portfolio itself of Nifty 50 is quite good. So I do not want to, spend a lot of time, put a lot of effort or put a lot of money into resources and people to create my own different portfolio. Rather, I just wanna, in a disciplined manner, invest in those same 50 companies that are there in the Nifty 50, so that at least I can get a return that is commensurate with the return of Nifty 50. You all get me? So that is what passive investing is. It's a very simple form of investing, and that's why obviously the return that an investor would make in a passive fund such as a index fund or an ETF would be same as the market return, excluding the tracking error. Obviously there will be slightly lower than that in reality, but in principle that would be the kind of return. And it's a very disciplined approach. Why disciplined approach? Because the fund management team believes that whatever the portfolio of Nifty is, whenever the Nifty's, company that creates the portfolio for Nifty, the Nifty indices, whenever they are gonna change any stocks in the portfolio, I will not apply my brains or I will not, apply my discretion, but rather in the 100% disciplined manner, I will replicate those changes in my portfolio as well. So that is why it's a very disciplined strategy. Now, on the complete opposite end of the spectrum is what is known as traditional active investing, which you can see over here. What is traditional active investing? Here, as the name suggests, there is a fund management team that are actively managing a portfolio. They believe that they have better research capabilities, better abilities to create a portfolio that can be much better than the portfolio of Nifty 50 or let's say Sensex or Nifty 500 for that matter. They believe that I can create a let's say 50 stock or a 60 stock or X number of stocks portfolio through my research, which can deliver better returns than Nifty, right? If the market can deliver about 14.5% return, then I have that ability, I have that mindset and that research capability as a team, as a fund house, that I can get better returns over a long period of time. Say for example, instead of 14.5 to 15%, about 17 to 18%. So that is why they believe that they can generate that active return, which is nothing but the excess return over and above the return that the market can generate, right? And that's why here the management is also quite different. It is discretionary because they will, research on different sectors, on different themes. They'll have different views. Some fund management companies may have a view on, let's say, artificial intelligence. Some may have on renewable energies. Some may have on semiconductors. Some may have maybe on auto ancillaries and so on and so forth. And according to their views, according to their research, they may select a portfolio of stocks. They'll have different research analysts who would be researching, different types of companies and different industries. And ultimately, based on their discretion, based on what they believe is, going to work out well in the future, they create that portfolio in the expectation that they will outperform the market, they will outperform Nifty 50 or whatever that benchmark is. So that is why that is the traditional active investing. Now, what is rule based investing? Rule based investing is active investing. Why passive? Because in case of passive investing, here the asset management company creates rules and they follow those rules in a disciplined manner. How it is different passive is because here the rules are created by the asset management company. So whatever portfolio, say for example, NJ is managing, for instance, the NJ FlexiCap fund, we have a 50 stock portfolio. So that portfolio's rules are created, they are written by NJ's team, by our team and our research analysts and fund. Otherwise, why would we put so much? Otherwise, why would we put so much effort in analyzing a huge, large set of data over the past 15 to 20 years? So that is the same expectation, just like a traditional discretionary active fund house. So that is why it is the best of both worlds. Just like passive investing, here in a disciplined manner, we are following a set of rules, and those rules pertain to everything. that what is going to be the universe of my portfolio, of my stocks, how I am going to select the stocks, how I am going to allocate the weightages to the different stocks in my portfolio, at what frequency I am going to churn the portfolio. In other words, at what frequency I am gonna enter into new stocks, exit from the existing stocks, when I am gonna rebalance the portfolio, how am I gonna limit the losses in the portfolio, and so on and so forth. So everything right from that universe till the end point, everything is fully based on a set of rules. Hence, it is known as rule-based investing. However, here also the rules are different, and that's why there is a potential to outperform in the long term. So just to give you an example of pizza between active investing and rule-based investing. So let's think about pizza making. So how would traditional active investing fit into the parlance of pizza making? Let's say in case of traditional active investing, the quality of ingredients would be predefined. And this is the kind of mozzarella cheese that needs to be used. This is the kind of loaf that needs to be used. This is the kind of vegetables or sauces that need to be used. However, what kind of how much proportion of mozzarella cheese needs to be mixed with the sauce and the loaf, and at what temperature the pizza needs to be baked, those things are not maybe fully predefined, and ultimately the output, the pizza that comes out, would be at the discretion of the person who is making the pizza. It would be dependent on the chef who is cooking the pizza. So think about traditional active investing as going to your local favorite pizza shop, let's say in your hometown or in Visakhapatnam or in Hyderabad or wherever your local favorite pizza shop is. Let's say you go there for 10 years, you order that same pizza, margarita pizza, and you get that same taste and satisfaction. But one fine day you go over there and everything changes. You don't get that same satisfaction, that same taste. What could be the reason for that? The reason could be simply that the person who was making that pizza earlier is no longer there making that same pizza, and that is why despite going to that same place, despite ordering that same pizza from your same local favorite pizza shop, still you are getting a different satisfaction. You are not satisfied with it. While in case of rule-based investing, think of a Domino's pizza store. So no matter whether you order Domino's cheese burst, margarita cheese burst in Visakhapatnam or in Hyderabad or in Surat or in Bombay or any XYZ part of the country, you're gonna get the same taste, the same texture, the same quality, the same output, right? You don't even know who is cooking the pizza behind the doors, who's making the pizza, but that does not matter. You're getting that same output every single time, and the reason for that is that they are following a set rules. They are following a set process, right from the quality of ingredients to the quantity to the mixing to the temperature at which the pizza needs to be baked. Everything is fully predefined. So that is precisely what rule-based investing is, to explain it through this pizza analogy, that because everything is fully predefined right from your universe of stocks to how you are gonna churn the portfolio, enter and exit different stocks, how you are gonna allocate between the different stocks, between the different sectors and so forth. That is why there is no fund manager risk, no key person risk. It does not matter whether I am the fund manager today or someone else is the fund manager in my NJ asset management company or in any rule-based shop for that matter. Because as long as those rules remain the same, that output remains the same. So, in terms of rule-based investing, I explained that you create different rules. But what kind of rules do you create? So, say for instance, if you want to select a stock, on what basis you are going to select a stock? So, generally there are different factors which are nothing but like your macronutrients like protein, carbohydrates, vitamins, minerals, and all. Similarly, there are certain macronutrients for any portfolio which are known as factors in the technical or in the academic parlance. So what are those factors? Factors are different characteristics which are essential for the portfolio's long-term health, just like the macronutrient for our health. So there are different factors such as the quality factor, the value factor, the low volatility factor, and the momentum factor. So what is the quality factor? Through the quality factor, you are trying to create rules which help you find out fundamentally super strong businesses that have strong profitability, strong return on equity, high cash flows, strong free cash flows, operating cash flows, low levels of debt, good accounting practices, and so forth. So that is the kind of fundamental strong companies that you try to find out through the quality factor. Then comes the value factor. What is the value factor? Very, very simple. It is the factor through which you try to find out undervalued opportunities in the market. So which stocks are trading at a discount to their intrinsic value. So generally people would be aware of ratios such as the P ratio, which is the price to earnings ratio. So that is one parameter within the value factor. Then there are other parameters such as PB ratio, price to book, price to sales, EV to EBITDA, or there can also be absolute valuation through the discounted cash flows model and so forth. So ultimately through the value factor, you are trying to find out undervalued companies that are trading at a discount to their fair intrinsic price in the market. Then comes the low volatility factor. What is the low volatility factor? Again, very, very straightforward. Here we try to find out companies, those are trading, whose share prices are not very, very volatile, whose trading activity does not have a lot of fluctuation, right? If a company's share price has a lot of fluctuations, has a lot of multiple upper lower circuits, and it is not a low volatile stock, it's a highly volatile stock. So through this low volatility factor, we try to find out companies in which the price swings are not that wild, the price swings are quite consistent, the price is in a consistent trend, it is going on. And ultimately the momentum factor. What is the momentum factor? Here you try to find out that which stocks or which segments of the market are in the flavor in the last, let's say, 6 months or 12 months or 3 months. So which are the recent near term winners over the last 6-12 months. And ultimately why you do that? Because there is this thought process, there is this concept of buy high and sell higher, which is basically the concept of momentum. Actually it is buy low and sell high in investing, but in case of momentum it is buy high and sell higher. That today you are buying a stock that has already risen at a higher price because it is in flavor, it is in good momentum, but you are buying it at a higher price because you believe that in the near future, let's say the next 6 to 12 months, because of that momentum of the stock, it will continue to go up even from this high point. So that's why we will sell it at a higher point. So ultimately these are the four main different factors through which we create different rules in rule based investing. Can you, yeah. So I explained about the different factors. Now I'll quickly touch upon what our core philosophy is. So in terms of rule-based investing, that is the strategy that we follow. That is the way in which we invest. We don't take any gut feeling based investment calls and this is the stock or this is the sector on which we are betting, which we believe is going to do well. We analyze a lot of data, analyze data of more than 1200 plus companies, all the NSE 500 companies we analyze, and basis that we create the portfolio. However, whenever we create the portfolio, what is the core belief that we have? The core belief that we have is that we want to invest in high quality businesses. It is the quality factor that drives performance over a long period of time. In the short run, any small cap stock, micro cap stock, any penny stock, any junk quality stock can also be a multi-bagger, right? Any Tom, Dick and Harry can have a 100% return in a short period of time. Any punter stock can also do very, very well due to multiple reasons such as sentiments and the momentum and flows and so forth. But ultimately over a long term, it is ultimately the business's fundamental quality, how strong the business is in terms of generating that profitability, that is going to drive its long-term performance in the share price, which will get reflected in the superior return. So that is the belief that we have, and across all our mutual fund schemes as well as the PMS strategies, that is something that we always keep in the forefront when making any investment decisions. And now in terms of quality, what parameters do we look at? So these are the parameters that we focus on. High and consistent ROE, which tells us how high the profitability of the business is, how consistent the profitability is, how high and consistently a business is paying dividends in relation to the profit per share or earnings per share that the company is generating, and how low the debt of that company is in relation to the shareholders' equity that the shareholders have put into the business. So, on the basis of that, we try to select the best companies that we believe are really good quality businesses. And why quality is important, right? Quality, if we invest in quality businesses, but quality businesses don't outperform over a long period of time, and actually it doesn't make sense to invest in quality, right? Do you all agree or not? I can't hear you. Do you all agree or not? If you want to invest in quality businesses, but if quality is not gonna outperform over a long period of time, then it doesn't make sense, right? So that's why we did a lot of research, and what this data shows is that if you create a portfolio of the best 100 quality companies, high quality companies, known as the NJ Quality Plus portfolio, and if you create a portfolio of low quality companies, companies that are junk quality companies, and you compare that performance with the market, which we can see over here is the Nifty 500, then clearly over a long period of time, investing in quality companies not just gives you better return. You can see that over a 19-year period approximately, the value of 1,000 rupees that was invested in the market rose to about 10,000 rupees. So there was a 10x ending value. Whereas in that same 19-year period, a 1,000 rupee value invested back in 2006 in the best quality businesses rose to about 29,000 rupees. So 29x the initial investment. So that is the kind of compounding, that is the kind of growth. And the most important thing, had someone put mistakenly the money in cheap quality companies or junk quality companies or anti quality companies as we call it, and they would have just compounded their money at 5.5 times the initial value, much lesser than the market as well. And over different holding periods also we can clearly see that why quality, superior quality does much better than the poor quality. And it is not just the performance what I was talking about, even in terms of risk, because how much risk you are taking to generate that better return is also very very important when it comes to investments, when it comes to finance, portfolio management. And in terms of the risk also, if you look at, then a quality portfolio has much lower risk for a long period of time in terms of your loss of capital, in terms of your volatility, as compared to a low quality portfolio or even as compared to the market. So this clearly shows that why it is very very important to invest in quality businesses over a long period of time. And as I was talking about, these are some of the funds that we've been managing on the mutual fund side. The three core flagship schemes that we have are the NJ Balance Advantage Fund, the NJ Flexi Cap Fund, and the NJ ELSS Tax Saver Scheme. The NJ Balance Advantage Fund and the NJ Flexi Cap Fund both are 50 stock portfolios. The only difference between the Flexi Cap Fund and the Balance Advantage Fund is and the Balance Advantage Fund is a hybrid fund which has the 50 stock portfolio of the Flexi Cap portfolio. At the same time, there is some exposure into debt asset classes and into arbitrage, so that overall asset allocation is done. So the risk is slightly lower, but the returns are also slightly lower. As compared to that, NJ Flexi Cap Fund is a 100% diversified equity portfolio of the 50 high quality businesses, and the ELSS portfolio is a portfolio of 25 companies. It's an aggressive portfolio, concentrated portfolio which invests more than 85% into mid and small cap companies. So it's a very very aggressive, concentrated 25 stock, high quality mid and small cap focused portfolio. And this is the process how we select the final 50 companies in the portfolio. So I won't take a lot of time on that, but this is if I have to simply say that we start from the top 500 companies, which are the largest 500 companies based on their market value, market capitalization, part of the Nifty 500, which includes all the large caps, the 150 mid cap companies, and the 250 largest small cap companies. From those 500 companies, we eliminate companies based on their forensic and governance ground, on their forensic and governance red flags. Then we apply further filters for volatility, for anti-quality. We eliminate loss-making companies. We eliminate companies that are burning cash. So all these new age tech startups and all, most of those companies get eliminated because they are not generating any profits or cash flows at the moment. And finally, we select about 80 to 100 best quality businesses, from which we select the 50 undervalued businesses that are trading at a relative discount to their intrinsic value, to their value compared to the peers. So that is how finally we create the 50 stock portfolio for the flexi cap fund, and the same we do it for the balanced advantage fund as well. So this is a very important and a very interesting statistic, because I would want to rather ask you guys that what do you all agree that diversification is the only free lunch in finance? How you all must have heard about this quote, right? It's quite cliche. Diversification is the only free lunch. Have you all heard about it or not? I can't hear you. Have you all heard about it or not? So, what is optimal diversification? Can someone just raise their hand, and according to them, what is optimal diversification? Can someone tell me? Anyone? According to you, according to your thought, according to what is optimal diversification? Or anyone, at least you can participate. Yes? Okay. Now, either of you can say.
So equity you can like allocate 50%, some of the allocation in golds, some of them in debts, like 50% equity, 30% in gold, and remaining in debts. So that
Okay.
kind of allocation.
Okay. So basically diversifying between non-correlated assets, that's what you're trying to say, right? Assets that are different from each other, unique from each other, whose underlying characteristics are different from each other, they are non-overlapping with each other and non-correlated. So absolutely, and that is what optimal diversification is, right? Diversification does not mean that you buy a lot of funds in your portfolio, or a lot of stocks in your portfolio, or a lot of assets in your portfolio. What is most important in terms of diversification is to look at how the different assets in your portfolio are correlated with each other, what is the overlap between each other. So to give you an example, if I just simply buy 10 to 15 mutual fund schemes, thinking that I've bought 10 15 mutual fund schemes, so my overall portfolio is very well diversified and my risk is managed. No, that is not optimal diversification, that is naive diversification, that is pseudo diversification, because what is more important than the number of schemes or the number of stocks or the number of assets in the portfolio is how overlapping they are with each other. So that is why we need to look at the overlapping between the underlying stocks as well when we are creating a basket of mutual fund schemes. So just to give you an example, even if you create a portfolio of 5 to 6 mutual fund schemes as opposed to a portfolio of 15 to 20 mutual fund schemes, but those 5 to 6 mutual fund schemes that you have selected are meaningfully different from each other. In simple terms, they have underlying stocks or underlying assets which are different from each other, and actually you will be much better off in terms of diversification, and that is why that overlap is very important. And what this data shows is that this is the overlap that we have in terms of our NJ FlexiCap fund with the Nifty 500 index, which is the benchmark. Only about 23% of the portfolio is overlapping. So about 77% of the portfolio is unique, it is different. And even if you compare it with the 40 other FlexiCap schemes that are there in the industry, and the average overlap is just about 18%. So 82%, more than 82% of the portfolio is unique, that is different. And that is what gives real, genuine diversification benefit to any investor. So as he rightly said, you have to diversify between equity, between debt, between gold. Within equities, you have to diversify between large caps, between mid caps, between small caps, and even within types of asset management styles, you have to diversify between active, passive, rule based, and most importantly, look at the overlap which is there between the different schemes or different assets in your portfolio to actually get the real benefit of diversification. So just to talk a bit about our smart beta platform. So I talked a lot about rule-based investing, that we analyze a lot of data, we do a lot of number crunching as well, 15, 20, 25 years of data. So how do we do that? We've created this smart beta platform. It is known as the NJ Smart Beta platform. It is our in-house proprietary research platform that we've created from scratch, and we have aggregated the data of all Nifty 500 companies that have ever been a part of Nifty 500 since the inception of Nifty 500 back in 1995. So more than 1250 plus unique companies are part of the Nifty 500 index, and all those unique companies data we have, all their fundamental data, their profit and loss accounts, their balance sheets, their cash flow statements, their consolidated financial statement, their standalone financial statements, their market prices, open, high, low, close prices, adjusted prices, unadjusted prices, corporate actions data, and ultimately we've aggregated this entire data set into this smart beta front end, which is the backtest engine. And this backtest engine is so beautiful, so amazing, that any kind of dynamic idea that I want to test, and I want to create this portfolio of 25 stocks, say I want to select these 25 stocks from so and so universe, and I want to backtest that strategy over the last 15 to 20 years and see how it has performed in the different market cycles, how it has performed vis-a-vis the other mutual fund schemes, how it has performed vis-a-vis the benchmarks, what was the drawdown in 2008, or what was the fall in 2020 during the COVID crash, or what were the kind of 3-year returns or 5-year returns, or what was the sectoral exposure in the portfolio, what stocks generated the return in the portfolio, what was the turnover or churn in the portfolio. So all those kinds of different quantitative analyses that any portfolio manager does before making an investment decision, all of those things can be done through this smart beta platform. And just to give you a context, through this smart beta platform, over the past 3.5 years, the NJ Asset Management's research team has tested more than 23,000 different strategies. So 23,000 different ideas have been tested through this platform. And the current strategies that we've incorporated in the FlexiCap fund or the Balanced Advantage or the ELSS is an outcome of those strategies that have been tested through this smart beta platform. So I talked a lot about rule-based investing, factor investing, why it is also known as factor investing, obviously because of the different factors. Talked about the smart beta platform, and specifically for those of you who are really interested to learn more about rule-based investing, about factor investing, how can you get a practical experience of that? So for that we have introduced this competition known as NJ Factor Investing Olympiad, NJFIO. The booklets have also been shared with you all. So it's a state-of-the-art competition. It is a premier competition for all the premier B schools. I am very proud to say that NJ Asset Management Company is the only asset management company in the entire industry that is running such a competition dedicated to factor investing, to quantitative investing for all the B school students since the past 2 years in the country. And this is going to be the third year next year that we would be doing in this factor investing Olympiad. And since the past 2 years, we had a lot of success in the competition as well. So as a student, why you should participate in this factor investing Olympiad NJFIO. Obviously, the reasons are very, very straightforward. And you will get a hands-on experience of asset management. You will be given real-world case studies. You will be, working as a founder of an asset management company launching your flagship mutual fund scheme, and how you are creating that portfolio, how you are pitching that strategy, how you are positioning it vis-a-vis the competitors in the market. You will get a lot of networking opportunities as well. All the top minds from IIMs like IIM Visakapatnam and all the other leading institutes, other IIMs, ISCs and all, they participate in this competition, and it's a very very cutthroat intense competition which is judged by industry stalwarts as well, such as Mr. Dhirendra Kumar from Value Research, or Mr. Sashi Krishnan, who is the director at the National Institute of Securities Market, or Mr. Neeraj Chokshi, who is the co-founder of NJ Group. Those kind of industry stalwarts who are experienced of more than 30-40 years in the industry, they are judging you, they are taking the decisions regarding who is gonna win this competition. And obviously there are a lot of prizes as well. It's a good resume boost as well. And as I said, this next year is gonna be the third season for our Factor Investing Olympiad. We had launched it in 2024, and that was the first season. And the format of this Factor Investing Olympiad is in two rounds generally. The first round is an online round, and once you register for it, you're shared the case study and the caselet and the questionnaire that you have to submit your responses. And then once you submit that through that online round, we shortlist the finalists for the grand finale, the national finalists. About 8 teams get shortlisted. 8 teams got shortlisted in the first season, and 8 teams got shortlisted in the season 2 as well. They and his team were part of the finalist team from IIM Visakapatnam as well for the season 2. And then finally in the grand finale, all the teams present their ideas, their strategies to the judges, to these esteemed judges, and then they finally select the top 3 national winners for the NJ Factor Investing Olympiad. And the beauty of this competition is that this Smart Beta platform that I talked about, the research platform that we use ourselves to create the portfolios, we don't sell it to anyone, we don't give it to any distributors or any XYZ third party persons who want to access that platform, but we give this platform to the participants of the NJ Factor Investing Olympiad. So the students participating in the NJ FIO get to experience the Smart Beta platform as well for a period of about 1 month or so. So it's a really good experience. You actually get to know what factor investing is, how you can actually implement all those classroom ideas, those theoretical concepts into real world portfolio management. And just to talk about the winners, so as I said, it is a very very cutthroat, intense competition. And in the season 1 that we did in 2021, there were 69 teams that participated across 39 premier B schools in the country. And as you can see, IIM Ahmedabad secured the first prize, followed by PDU that secured the second prize, followed by the team XLRI medallion from XLRI Jamshedpur. And obviously there's a good enough cash prize as well, a good incentive in terms of earning some good amount as well for the participants. And even the season 2, it was even more intense. While the number of teams that participated was slightly less, 57 compared to 69, while the quality of the teams in season 2 was even more commendable, and it was very very phenomenal. And as you can see over here, ISB Mohali, they won the first prize this year, which we did the season 2 grand finale in August 2025, followed by ISB Hyderabad, who secured the second place. And this year the competition was so intense and we had to declare a tie for the second runner-up between two teams, IIM Ahmedabad and IIM Raipur as well. So that is basically the second runner-up team that was there. And I'll just quickly and conclude the session now. So before I conclude, I would just say that try to think about it. The Factor Investing Olympiad is a very very great opportunity for anyone who wants to participate in this. Anyone who is interested to know more about factor investing, definitely you can spread the word, not just to your friends in IIM Visakapatnam, but across the different universities also. We would be eager to host as many students as we can in the season 3 of NJ FIO, and trust me, it will give you an immense lot of learning, and a lot of things are mentioned in the booklet as well. Due to the paucity of time, I am unable to cover a lot of those things, unfortunately. However, I would just request you all to take a few minutes, just a minute or so, to scan the QR code and give your valuable feedback on this. Thank you so much.
I just had a question. Being a finalist in the NJFIO and learning few things about rule-based investing, I just wanted to ask, how do we connect these factors with the macroeconomic perspectives like GDP growth rate?
Right, right.
So a lot of things are momentum driven, a lot of things are share price driven
Right.
when we talk about the factors. How do we connect that with the macro environment?
So very good question. So the factors that we discussed in the presentation, and generally the factors that you all used in the factor investing Olympiad, the quality, value, momentum and low volatility factors, those are factors known as style factors. They are style factors because they represent a specific style of a business or a characteristic of a business, and those style factors are used mainly for stock selection at a bottom of security selection level, at a top down level or at a macroeconomic level. If you want to use factors and what is known as macro factors, you need to use those macro factors, and macro factors are nothing but factors such as GDP growth or interest rates or inflation and so on and so forth. So there are a lot of macro factors as well, which are generally used for asset allocation or a more top down approach rather than a bottom up approach for stock selection. Now, if you want to link style factors with macro factors, then one thing that you need to know is that all these factors by nature are cyclical. What that means is that different factors will perform well or perform bad in different market environments. So, say for instance, when the GDP growth is good, when the market is doing well, when the economy is doing well, and there's a bullish phase, momentum is going to do well. So that is how you can link that. Or say for instance, when there is a recession, GDP growth is negative, and let's say maybe inflation is also high, or there's a stagflationary environment. In those cases, obviously, momentum is not going to do well, but a defensive strategy, a defensive factor such as low volatility or quality is going to do well. Or let's say when there is a big market crash or a big economic crash, and the markets and the economies recover from there, at that point of time a factor such as a value factor is going to do well. So that is how you can link the different style factors with macro factors as well. In high interest rate environments, again, value as a factor will do well. When interest rates are low, growth as a factor, which is also another factor, will do well compared to value. So that's how you can link the two as well.
I just had a question from a business perspective of an asset management company. Um, as you mentioned that there were 23,000, more than 23,000
Yes.
portfolios tested by MJ
Yes.
employees. Don't you think that having a competitive advantage in an environment where the quantitative strategies can be replicated by another asset management company also is also a threat kind of a thing to a business?
Not at all, because see, ultimately it is your brain. If someone can replicate your brain, then definitely, but that brain can be replicated even in active investing as well. It is not that it is just an algorithm that we are running in the back end and leaving it all by itself, and then just telling that we take investment decisions based on whatever output we are getting from that algorithm. Those rules that get into each of those strategies, each of those 23,000 plus models that have been tested, the brain is of the asset management company's research team, right? So if that can get fully replicated, then obviously then someone can completely replicate that. But that is true for any business, that is true for any form of asset management, even traditional active asset management. If let's say you are an active fund manager and you are doing very well, and I as another fund manager can completely understand your mindset in your thesis, and I can replicate all the decisions that you are going to take, obviously then you will lose your competitive advantage in that case.
Hello, sir. My question is that rules-based investing is mostly follows predefined rules. So, as investors, how much visibility do we get into these rules, and how do you balance transparency with the need to protect proprietary models?
Okay, very good question. So First of all, in terms of rule-based investing, yes, it is based on predefined rules. But how robust your rules are ultimately, that is going to determine how resilient your portfolio is going to be, right? And it is not that since you created a set of rules, now everything is gonna happen based on that. So the fund management team or the research team can go on a leave or take a sabbatical. It's not like that. You have to monitor those rules on a regular basis. You have to see that what had worked back in the back test, whether it is working as per that expectation in the reality as well. And also markets also are dynamic, things also keep on changing. So there is always a constant need, not obviously very frequent, but at certain points in time where you need to keep on enhancing your models as well, enhancing your rules to incorporate the new evolving things that are there in the market, specifically with AI and the kind of disruption that is happening. You need to be very, very agile. So if you are agile in that sense, if you are monitoring your rules in the real world, you are regularly seeing whether the performance is as per the expectation or not, which was there in the backtest, and your rules, most importantly in the first place, are robust as well, and definitely that resilience can come in rules-based investing. And point number two, in terms of transparency, see here, as opposed to an index fund or any passive fund house or any strategy which is based on an index, mainly say a smart beta index as well, that each and everything is fully transparent in the sense that how they are calculating the parameter, at what level they are capping or flooring the different parameters, when they are going to rebalance based on what set of strategies, and each and everything is fully predefined, and it is transparent, it is shared, it is open to the public. If you go to NSC's website as well, then basically you can see everything in the NSC Nifty indices methodologies as well. You get everything out open, and there's no hiding at all. But when it comes to proprietary rule-based models such as active rule-based models such as NJ FlexiCap funds, say for instance, so there obviously we will be transparent in terms of how the decisions are made, how the framework is there to select the stocks, to allocate the weightages to the stock, but each and every minute detail we are not going to share, because we are not obliged or obligated to give each and every information out there. So obviously that is how we'll maintain that proprietary IP along with us as well.
Thank you. Hello, sir. So when they ask this question, that like macro factors are also very important. So in rule-based investing as well, like there would be some sort of discretion involved, right? Like as you said, that the mind cannot be replicated. So how is it like really different from the traditional investing wherein like fund managers manage? Like in that also, like they definitely use some funds, like they use some rules, and then like with their discretion they change whatever they want. Like they are
Right.
basically using their mind. So how is
Right.
it different?
So see here, in case of rule-based investing, that mindset is mainly applied to create the rules, to test different rules. Once I finalize a set of rules, then I don't apply my discretion or mindset in the sense that now, let's say AU Small Finance Bank, I am big fan of AU Small Finance Bank, for example, let's say it's my darling stock and it did not come in my portfolio based on my set of rules, and now I am not going to apply that discretion or apply my mind, and instead of let's say Aptus Value Housing Finance, I will not buy that, and instead of that I will buy AU Small Finance Bank in my portfolio because I like that stock or I know the promoter or any XYZ reason. So that is the main difference. That's where that discretion will not be applied. Furthermore, here in rule-based investing, we will not apply discretion in the sense what sector or what stock or what industry is going to outperform, right? We are not trying to predict that semiconductors are going to be the next big thing or the next big winners or beneficiaries, or AI is going to be the big thing and the companies, investing in AI, R&D or revolving around those themes are going to do very, very well. We are not trying to predict what is going to happen in the future. Rather, based on those set of rules only, then in a disciplined manner we are executing whatever output that we are getting. And what is that output? That output is the portfolio that we are getting. There we are not having any human biases. And as opposed to that, in case of active investing, the fund manager obviously will have some kind of quantitative filters and all at an initial level, but then ultimately he'll go and meet the company's management, the promoters, maybe also meet the competitors. He'll do his or her, ground level analysis. His team will do the analysis, and ultimately what stock to buy in the portfolio, how much allocation to give, when to sell the stock, whether to buy AU or to buy actors. All those decisions will be taken by the fund manager, and that's why that discretion is there. And why that discretion is there? Because they are trying to take calls on the future and what is going to happen. As opposed to that, rule-based investing is backward looking. It is looking at the data, it is looking at the history, it is looking at the long-term trends, that what has worked out and the reasons for that, and basis that we are creating that strategy. I hope you got the answer.
Yeah, so I had a follow-up question. Okay, so don't you think that maybe that discretion is a bit important eventually, and maybe like we should maybe put some money in one of the funds and some money in like the rule-based fund, so that.
Absolutely, absolutely. So see, that discretion is also there, but again, predicting is very, very difficult. Why predicting is very difficult? Because if you look at the US data, more than 90% of the active fund managers who try to predict are underperforming the benchmarks, and that is one of the main reasons why people are investing into passive funds or into rule-based funds in the US. And the reason for that is not because they are not skilled, the active fund managers, or they don't have that kind of bandwidth. The reason is that because the business world is so evolving and dynamic and complex, and due to the speed at which the information is passing from one person to the other, from one corner of the world to the other, there is no information arbitrage that the fund managers have to take a bet on something that they know is gonna turn out better compared to the rest of the players. So that is why it is extremely difficult to predict, and that's why they are underperforming. Now, in case of the Indian market, again definitely it is not the case here because it's at a recent phase. There are a lot of opportunities as well for active fund managers as well to predict and make such kind of active portfolios based on their discretion. But again, consistently taking the right calls for any fund manager, be it in India or in US or in China or in Europe or in Singapore, is very, very difficult. You can check the data as well. And that's why, as you rightly said, don't put all your eggs in one basket. You should have some allocation in active funds, some allocation in rule-based funds, and maybe if you want to be a bit conservative, some allocation in passive funds as well. I think we can conclude then. Thank you.
Thank you so much, sir, for this amazing session and all the participants for asking the questions. We all found it incredibly insightful. As a token of appreciation, we are honored to present a special memento to our esteemed speaker. I now invite Somsekhar sir from CDS office to come to the stage and present the memento. I would also like, sir, to request